Did you know your IRA can lend money and earn interest just like a bank? Most people believe IRAs are limited to stocks or mutual funds and whatever their brokerage platform offers. Well, since IRAs were created in 1974, the Internal Revenue Code has allowed retirement accounts to make loans and earn interest. That means your IRA can act as a lender, not you personally, your IRA. So if you're looking for diversification, more control, and potentially predictable income, using your IRA like a bank may be one of the most powerful and overlooked strategies available, especially because the interest and principal received is tax-free. Hi everyone, I'm Adam Bergman, tax attorney and founder of IRA Financial. For more than 16 years, I've helped investors take control of their retirement funds using IRS-approved self-directed strategies that go far beyond Wall Street. Today, I'm going to show you how IRA lending works, why investors use it, the tax advantages, and the rules you must follow to do it correctly. So let's start with the foundation. First, what makes this possible? A self-directed IRA, of course. Now, technically, every IRA is self-directed under the tax code, or is it? But most brokerage firms limit your investments to publicly traded securities. That's the problem. A true self-directed IRA gives you control to invest in alternative assets like real estate or private companies and private lending. It's not a different type of retirement account. It's just a different level of control. Same IRA rules, same contribution limits, but expanded investment options. Think of it as a structural upgrade, not a new retirement vehicle. And one of the most powerful uses of that flexibility is lending. If you want a deeper explanation of how self-directed IRAs are structured and how they differ from brokerage IRAs, I break that down in detail in another video. But for now, let's focus on how lending actually works inside the IRA. The flow looks like this: IRA, loan, interest payment, tax-free to your IRA. You're not lending personally. You're not receiving the interest personally. Your IRA is the lender, and your IRA receives the income tax-free. Common examples include real estate lending, private mortgages, bridge loans, hard money loans, loans to operating businesses, note purchases, structured lending inside private investment funds, like credit funds. In each case, the IRA earns interest, tax-free, not you personally. And that distinction is where the tax advantages become so powerful. Investors don't choose IRA lending just because it sounds different. They choose it for strategic and tax-efficient reasons. First, income predictability. Unlike equity investments that fluctuate daily, loans often generate defined or set interest payments under agreed upon terms. Second, diversification. Lending can reduce exposure to public equity market volatility. Third, control. You select the borrower, you negotiate the terms, and you evaluate the collateral. Fourth, familiarity. Many investors prefer investing in opportunities that they understand, like a local real estate deal, businesses in their network, or structured lending arrangements. This aligns directly with the broader philosophy of investing beyond Wall Street. But the real advantage isn't just control, trust me, from a tax lawyer, it's taxation. Let's compare three identical lending scenarios. Same borrower, same loan terms, same interest rate. The only difference is where the investment lives. Scenario one, you lend personally. The interest income you received is taxed as ordinary income, not capital gains, ordinary income. If you're in a high tax bracket, that could be up to 37% federally, plus state taxes. Scenario two, you lend through a traditional self-directed IRA. The full interest amount can be reinvested and compounded tax-free. Taxes are paid only when distributions are taken in retirement. Scenario three, you lend through a Roth self-directed IRA. The interest income flows back to the Roth IRA tax-free. If the Roth rules are satisfied, you're over the age of 59 and a half and the Roth has been open at least 5 years, a qualified distribution, all distributions are completely 100% tax-free. Same deal, same borrower, completely different tax outcome depending on where the deal lives. That is the power of tax-advantaged compounding. And that is why I love self-directed investing and the power of Roth so much. Now let's talk about compliance, because this is where some mistakes happen. The most important concept is prohibited transactions. In essence, your IRA cannot lend money to yourself, your spouse, your parents, your grandparents, your children, grandchildren, Essentially, any business, those individuals or you control or own 50% or more. Essentially, your lineal descendants. Those are called disqualified persons. If you violate this rule, the entire IRA can become taxable. Other common mistakes include titling the loan incorrectly. For example, using your personal name instead of the IRA. Failing to document the transaction properly. Charging below market interest rates, like a gift. Not using a formal promissory note. Or using too high of an interest rate, usury laws. Every loan must be properly documented, structured at arm's length, titled in the name of the IRA, plus supported by fair market terms. This is where IRA Financial comes in. This is where professional guidance matters. You focus on identifying the opportunity. We help ensure it's structured correctly from an investment, tax, and retirement perspective. Now let's be clear. Lending involves some risk. There's credit risk, there's borrower risk, there's collateral risk. IRA custodians do not guarantee performance. Due diligence matters. Underwriting matters. Who are you lending to? What are the terms of the deal? Is there collateral? Diversification matters. Retirement capital should be deployed thoughtfully, used responsibly. Lending can be a huge part of a diversified retirement strategy, but it should never replace prudent risk management. This is another area investors often overlook. Many providers will open an IRA account for you, and that's where their service literally ends. Some charge asset-based fees, which is ridiculous, that grows as your account grows. Some provide little compliance guidance. In fact, most self-directed IRA companies provide absolutely zero guidance. Some leave you to figure out documentation and reporting alone. This is a major issue. At IRA Financial, our approach is way different. We structure accounts for your strategy, not generic investing. We use a flat fee pricing model. We provide personalized onboarding. We assist with lending setup, compliance, documentation guidance, and ongoing tax compliance support. You focus on investing, we help handle the structural complexity and all the tax-related matters involving the investment. That's a true partnership. Here's what this looks like in practice. A real estate investor uses their IRA to fund short-term bridge loans secured by property, or an entrepreneur allocates a portion of their retirement funds to a private credit fund. An investor builds a diversified portfolio of performing notes inside their Roth IRA. Notice what we're focusing on: structure, strategy, compliance, and control. Over the past 16 years, we've helped open more than 27,000 self-directed retirement accounts. Our clients have invested over $5 billion in alternative assets. Our team has written extensively on self-directed and retirement law. This is not experimental. It is grounded in the tax code and decades of experience. If you're looking for greater diversification, more control, and tax-efficient income, using your IRA as a lender may be a super powerful strategy. The key is doing it correctly, understanding the tax advantages, respecting the compliance rules, structuring each deal properly from day one. If you'd like to learn how IRA Financial can help you set up and structure a self-directed IRA for lending, schedule a free consultation with one of our retirement specialists. And I'll see you in the next video.